Target begins closing stores down as retail chains prepare for dark winter. This is the worst shakeup in retail history, and one chain in particular is affected the most. Target, the big box retailer, has been in turbulent times recently. Store sales have slumped for the first time in 6 years. It is losing millions of dollars in sales and has been devastated by its falling market value. It was one of the businesses that won by winning a whole lot of customers, but now it's losing its value. Profits falling by 40% in the first quarter of 2023 and plunged 90% in the second quarter compared to last year. The company's value has fallen by $12 billion. Negative customer sentiment is the biggest threat the retail store is facing. As of now, it finds itself in the midst of a public backlash, and the reputation has been dented. All this is affecting its performance. The U.S. department store chain is facing a severe backlash from consumers and shareholders alike. Despite having spent over 6 decades establishing itself as a household name, the company's reputation has taken a significant hit. Sales at Target have plummeted at an alarming rate, and many consumers have resorted to boycotting the stores. Some have even likened Target's situation to Bud Light 2.0, a reference to the catastrophic campaign that led to a 45% decrease in parent company Anheuser-Busch's stock and over $400 million decline in sales since June. Target's current struggles aren't a recent development, as the company has been in a slow decline for years. Despite several efforts to revive the business, the brand's woes continue. The latest blow came from retailers' announcement of store closures in October, which will affect locations in major U.S. cities, including New York, San Francisco, Oakland, Portland, and Seattle. The company's reason for the closures was poor financial results. Target acknowledged that this factor has contributed to the brand's unsustainability, as stated on its website. Not long ago, Target made public its struggles with shrink, the term for the loss of inventory due to shoplifting. This issue has cut deeply into their profits, and they now anticipate losses of up to $1.2 billion in the current fiscal year. This problem has impacted their earnings significantly. According to a survey conducted by the National Retail Federation, shrink accounted for 1.6% of losses across the industry in 2022, totaling $112.1 billion. Organized shoplifting was responsible for the majority of shrink, approximately 65%. While measures are being taken to prevent further losses, the NRF has reported that drastic actions will be necessary. Retail crime has forced 30% of retailers to close their doors and 45% to reduce operating hours. Additionally, 30% had to alter or decrease their product selection due to this issue. The retail store is facing the looming threat of another billion-dollar loss. In 2023, Target suffered a loss of over $14 billion in market capitalization. The company has resorted to its last-ditch efforts to save its business. The overall financial performance has been on a sharp decline since last year. Recently, the chain reported its first double-digit sales decline in the digital category and the largest drop in comparable sales at physical stores in at least 4 years, adding to investor concerns. While the company was one of the major beneficiaries of the 2020 health crisis, its success was short-lived, lasting only 18 months. It saw a surge in demand and steady growth for several months as Americans used their stimulus dollars to buy home goods, but all of its gains have since been wiped out. In 2020, Target was permitted to remain open early on due to its food sales, and its revenue soared by 40%, surpassing Walmart and Dollar General. Last year marked the beginning of a downward spiral for the retail giant. The company's sales slowed, yet inventory continued to pile up. Executives tried to remedy the situation by offering steep discounts, but the U.S. market remained hesitant to make discretionary purchases. The sales plummeted, and investors began to flee from Target stock, and it has seen a significant drop in value with a decrease of over 20%. This has led to a decline in sales and a notable departure of investors. Previously priced at $160.69 per share, Target now stands at $112 per share. Shareholders are anticipating that the consumer boycott will endure for several months, resulting in a gloomy sales outlook for the upcoming quarters. Consequently, they are continuing to rapidly sell off their stock due to the company's disappointing financial performance. The upcoming quarters may witness sluggish sales trends, indicating a weakened demand for certain key product lines. According to a recent note from Trevor's team, which comprises MIT engineers and Wall Street analysts, it is expected that the company shares will face ongoing pressure in the short term. In addition, Bobby Riven, an analyst at Raymond James Financial Incorporated, expressed reduced confidence in the near-term sales trends and profit recovery of the company in a recent note to clients. As a result, the firm is downgrading its rating on Target, citing evidence that suggests a decline in the retailer sales momentum. According to market analysis of Morgan Stanley, it is expected that Target will likely revise its annual earnings forecast downward in its recent earnings report. The current forecast stands at $8.75 per share, but it is anticipated to be reduced to around $7 per share. Target's revenue was disclosed to have declined over the course of last year, amounting to $25 billion. This decrease was mainly attributed to a significant decline in sales at physical stores. In addition, digital sales also experienced a drop of 10.5% in the second quarter. These figures reflect a challenging situation for the store, further exacerbating the existing difficulties they face. Executives of the company are exploring various strategies to address declining sales, with CEO Brian Cornell focusing on cost control and combating organized retail theft. Additionally, they aim to expand its footprint in the food sector, where competitors have seen revenue growth. Target is investing in enhancing its fresh food offerings and expanding its private label products for budget-conscious shoppers. However, it's essential to consider that the grocery industry operates on thin profit margins. Despite decades of effort, food and beverages constitute only 20% of Target sales. In simple terms, the transition to groceries poses challenges, and it might take several years to witness a positive impact on the company's financial performance. During this time, other factors could further jeopardize the company's future. Cornell has attributed Target's current crisis to broader economic challenges, such as financially strained consumers who are reducing their spending due to higher inflation, and the resumption of student loan payments this fall. However, the company's own executives believe that the negative response to the Pride assortment was the main factor impacting sales this year. During an earnings call, the chief governance officer of the firm described the headwinds as detrimental. The international head of brand communications, Nicole Gillard, expressed her belief that the campaign was like a car crash waiting to happen. "We really have lost our way. We've forgotten where we came from and have lost our identity, have forgotten who we really are, and we aren't really confident and clear in where we are going," she said. They are clearly struggling with flat sales over the period of a few months. Target's total revenue in the first quarter of 2023 was up only 0.6% from the same period a year ago, and comparable sales were flat compared to last year, while comparable store sales rose only 0.7%. Target is facing intensifying competition from other retailers, which is impacting its business. The retail industry is highly competitive, and companies are required to handle the pressure of several companies competing for market share and growth. As markets become increasingly competitive, companies must find new ways to differentiate their offerings from others in a crowded market. This often results in increased competition among businesses operating in the same market, making it challenging to differentiate and attract customers. To stay ahead of the curve, businesses tend to focus on their niche, invest in marketing and advertising, and differentiate themselves from competitors by catering to the unique needs of their target audience. Target has been lowering prices since the beginning of 2017 to win back customers and has completed top-to-bottom remodels across nearly half of its stores since 2017. But that hasn't helped all that much so far. Furthermore, they also face competition in the e-commerce industry. Amazon dominates the market with a 38.7% share, while Target's share is only 1.2%, making the former more favorable among national and international audiences. Target stores have been facing supply chain disruptions that have affected their inventory and profits. Profits in the second quarter of 2023 collapsed by nearly 90% year-on-year due to ongoing supply chain management issues. Other top retailers like Walmart and the Home Depot are also confronting challenges around supply capacity, risk visibility, increasing costs, and delivery reliability, especially from international sources of supply. The transportation cost in 2022 is projected to be $1 billion higher than last year due to higher costs and ongoing challenges. Target and other retailers are facing substantial costs related to ongoing supply chain issues. It could be among the first U.S. companies to take a direct hit from the coronavirus outbreak as concerns about supply chain disruptions grow. The store has been taking aggressive steps to get rid of extra inventory. Investors and financial experts, including Kevin O'Leary, noted that Target's loss in market value was unprecedented and attributed it to the company's perceived prioritization of certain product offerings over investor interests. O'Leary emphasized the importance of businesses focusing on their primary objectives, which include serving customers, managing employees, and delivering value to shareholders. The stunning collapse of Target's market cap is almost unprecedented for its own stock in 20 years, and how this happened is being scrutinized by lots of other boards right now, he stressed. If you start to get too distant or too far away from the primary mandate, the market has proven itself to really punish you. He also said, when you lose $14 billion of market cap, there are a lot of unhappy cowboys out there. They're called your investors. He has expressed the urge to take immediate action to resolve these issues. Investors are very concerned about the ongoing crisis. They might stop putting their money in the shares, which have already lost a lot of value. Target has been in chaotic times recently, with a lot of things not going their way. If they fail to manage it effectively, they might end up collapsing. Comment down below on what you think, and leave a like if you find value in the content we do on this channel. Hit the subscribe button for all the latest updates, and we'll see you in the next video.